Hello, my name is Mitch Kramer, and I'm the CEO and founder of Fluent Financial. Trey Talley, who is the head portfolio manager for Fluent Financial. We're going to be talking about the significant events post-election, what's going on in the markets. And as we did our practice run through, some of the slides we looked at today indicate a much more ominous economic landscape than a lot of people have been seeing in the media. We're not trying to scare people, but what we've been talking about for many, many months is starting to come to fruition. Um, so we'll go ahead and get started. The first slide, the opinions provided by myself and Trey are Fluent Financials, not private client services. And with that, I'll turn this over to Trey.
Thank you, Mitch. Hello, everybody. So we're going to start off kind of as we always do with the monthly updates, talk about what's going on in the economy and markets, jobs. And here we've got a picture of just a few indices here for almost 3 years since kind of some of the trouble began back in early 22. And so most of the action has been in the large cap indices like the S&P 500 and the NASDAQ. And those are up, 9 and 22% respectively over that time period. Global 60-40 portfolio over this almost three-year time frame is up just under 8%. Of course, bonds, we're still dealing with high interest rates and inflation. So the global bond portfolio total return is still down about 11.5% over this time period. Small caps, value stocks, they've kind of been having a tough go at it as they're leveraged to the economy, and we really haven't seen much organic strength there. With that, we'll go ahead and kind of dive in, looking at the leading economic index here. And so we've got just a different illustration this month around the year-over-year metrics is kind of what we normally post here, and those are still negative. But we wanted to illustrate that the leading economic index is still in decline, and we've really broken below our post-COVID lows. And we see here that anytime generally we get this type of decline here, it portends a recession. And really, you can even lay over the S&P 500 or any stock market index, and it generally tracks pretty correlated. We've seen this is one of the few times in history that this is diverged pretty strongly here. So the economy, the underlying organic growth in the economy is actually quite weak, but stocks have continued to move higher. Stocks are very strong right now. We'll talk about that in a second. Performance here, next one. We look at some of the models, and a lot of the narratives are still the same. So a lot of the action, again, is being driven by the large cap portfolios. And so the more leveraged to the economy names like the Dow Jones, the world indices, kind of still struggling over this kind of 2 to 3 year time frame. Year to date, we've seen some broadening in that trend, which is a good sign. We've seen some of the equal weight indices pick up here. Small caps initially kind of found a little bit of reprieve after that first rate cut. And then the bonds continue to suffer here through this year, and the path of rates is from here is lower. But our portfolios, we've got them de-levered. We want a low beta in this environment. We want to be able to participate in some of the gains, check all the boxes we need to make sure that our clients are hitting their numbers to get and to stay in retirement, but avoid all the big hiccups because those can be disastrous for retirees. And so we want to make sure that we're balancing the risks and rewards out there. The risks continue to grow. Mitch, we'll kind of hop into the hope slides there if you want to take it.
Sure. So the hope slide, this is something we've shown the last couple of years. And as you guys have seen, we're at the last leg of it where unemployment is starting to get weak. And we've got quite a few slides. We'll talk about that later. When you look at housing, really, the housing market index, the overall trend is negative. It's going down, and this reflects a weakened customer. Interest rates are still relatively high compared to historic measures. People don't have enough money to buy a house. A housing permit, which is the leading indicator on this particular side, it kind of mirrors what you saw on the previous slide. It's trending negative as well. If we look at new orders, it's going down as well. This is manufacturing. Again, it's still negative. And services, which is much more volatile, it can go up and down. So you see some noisy information from month to month. It's still above 50, so it's in an expansion phase, but it's not strong. If you look at from 2020, it's trending downward. And then all this reflects in the profits. And we talked last month and prior months where we've got a big disconnect. So when you look at this slide on the chart, the white line represents the stock market, then earnings per share is the yellow line. Think of this as a shark jaw with jaws that are opening about ready to snap shut on the US consumer and the economy. You can't have a stock market go up and profits go down. That's not a sustainable path. And then unemployment, again, this is the last shoe to fall in the hope cycle. When employment numbers start to uh, perk up in terms of people being laid off and unemployed, that's when a recession starts. So if you look at these red bars here in prior recessions, you can see the jump up in employment, people filing for unemployment claims. We're seeing that happen here. And then the unemployment rate did drop a little bit from 4.2 down to 4.1. But I think a real important statistic to understand is that in the last 3 years, 1.5 million people have been hired by the federal government. Let me repeat that: 1.5 million. And I know the new administration is going to go in and cut overhead, cut cost. Both Vivek and Elon says they can easily cut 1 to maybe 2 million people right off the top. So a lot of people in the federal government are very worried about their jobs. So I'm going to turn the next slide over to Trey, who's going to talk a bit more about the inflation and what we see happening there.
Thanks. So here we're looking at kind of the year-over-year metrics for inflation, the headline CPI. That's the white line that's kind of embedded there. Just disaggregates some of that inflation in terms of different pressures. And as we see that the large amount of inflation that we're still experiencing is core services. It's kind of what we refer to as sticky inflation. And that's going to require job losses to kind of break through that. That's the whole point of the Phillips curve. We'll get to that. Goods are actually in deflation, which is kind of a rarity here. So we've got a good bit of help here from energy and core goods. Food inflation is still with us, but it's very moderate. Core services is going to take some time to get through here. We're getting disinflation, but we're not below the Fed's target here. So we are getting rate cuts, but ultimately the path of those rate cuts is going to be determined by inflation. Here we're looking at that path of rate cuts. And we can see we'll likely get, it's almost a coin toss, but we're likely to get another Fed cut here in December in about 4 weeks. And then we're going to kind of decelerate just a little bit with about 75 more basis point worth of cuts priced into the curve for next year. So the curve has kind of pulled out some of those rate cuts as some of the economic data has improved a little bit. If you remember coming out of the summer, there was a big swoon in kind of the job losses there. We had a huge spike in the unemployment rate. Fears precipitated very quickly, and yields crashed. Stocks were having a very tough time. That was exacerbated by the yen blow up, and so some of that is reversed. We've gotten some better reports on jobs. The incoming Republican administration is obviously very pro-growth. They're very pro-tariff in terms of nationalistic policies that could introduce some inflation as well. So the Fed's saying, look, we're gonna cut rates. The path of rates is lower, but we just want to make sure we moderate the risks here. And I think that's kind of the prudent call. We don't want to cut too fast and reignite inflation, and then kind of have to do all of this headache over again. So I think that they're balancing the risks well there, and we'll kind of leave inflation and start to kind of talk about market valuations from a very high level. So this first slide we're going to look at. So this is 150 years worth of data. This is the Shiller-Cape ratio. And so what this is it's a cyclically adjusted price to earnings ratio. That's what CAPE stands for. It's the S&P 500 divided by the 10-year moving average of inflation adjusted earnings. It was created by the American economist Robert Shiller. It's widely used, and it's used as a valuation metric to forecast future returns, whereas a high CAPE ratio indicates lower forward returns, vice versa. Where we are right now at over 35 CAPE PE, CAPE ratio is about twice the average over 150 years worth of data. The only time that we've really been in this kind of neighborhood in terms of valuations is the 21 post-COVID bubble that led to a 25% drawdown the following year. The run-up to the tech bubble, which gave us a multi-year bear market, and the NASDAQ collapsed about 70%. And then, of course, the only other one is the lead up into the Great Depression, particularly the 1928 and 29 stock market parabolic move there. So we're really in rarefied air for valuations. This takes a very long-term approach and a very long-term forecast that should kind of give us some concern about forward returns regarding mostly the S&P 500 here in the U.S. Many different markets, many different assets, but here for U.S. stocks, we've gotten into rarefied, rich area. The next slide is going to kind of help depict that a little bit more. So this comes here from JP Morgan, and they're looking very similarly at forward price to earnings ratios, and they're looking at subsequent 1 and 5 year returns. On the left, that's the 1 year returns. And so we've got the linear regression over the following year. Expected returns are essentially flat for the market. Now a regression is a best fit. It is not a predictor necessarily. It is the line of best fit through your data. Most of that data is consolidated below the zero bound there, indicating negative forward returns over the next year. And there's a large cluster of data there based on how expensive we are at market level. A lot of those data points start to center around a 15 to 20% drawdown in markets. And even when we take a 5 year picture going from here, now that's the right side of the slide, those are more clustered towards the regression. That's good. But the forward returns over the next 5 years annualized are in the very low single digits. And so there's a number of ways that can happen. It doesn't mean we have to crash. It just means forward returns from here are going to be incredibly nominal, maybe just barely enough to break even above inflation. That's how much of the future we've pulled forward. U.S. markets are priced for perfection. Rarely do we see any perfection in markets. Last one we'll look at for valuations is just kind of taking a multi-asset level look at valuations. And that's everything from U.S. large cap on the far right to U.S. treasuries on the far left. What we're looking at is standard deviations above or below their 25 average valuation. So it's much of the same theme. In the U.S. stock market, we see valuations anywhere from 2 to almost 1.5 standard deviations above their average valuation. And kind of conversely, we see what's undervalued right now is really what we've been kind of trying to lean into for the past 12 months, which is kind of more high quality fixed income. There we get solid yields that pay us to wait. The path of rates is lower, and the big payoffs come when yields go down and depressed economic environments. So the payoffs come when you need them most. One of the underlying themes through all of these slides that indicate valuations here for markets is that the theme is that it's kind of as good as it gets. For years, you've been able to ride the passive wave, just kind of buy and hold. And stocks generally went up without too much volatility. From here, that's going to be a very different story, where passive is going to fall behind active management, where you'll need to be able to broaden outside of U.S. stocks into other asset classes and be able to take different strategy approaches to navigate this, much of like Fluent Financial did in the early aughts coming out of the tech bubble. So this is going to be a very different environment that does favor active management. Everyone on this call is under that umbrella and can take a sigh of relief here. But this is going to be a very different regime over the next 5 to 10 years. Next slide we want to look at is bond yields. A lot of talk about bond yields, what's going on. Fed cut 50 basis points in the middle of September. Yields rally, what's going on there? So part of that has been driven again by the improvement in the economic outlook for the economic surprise index is what we're looking at here on the blue line. And then the gold line is U.S. 10-year yields. So we've seen some improvement. If you remember in the summer, we got a triggering of the SOM rule. The unemployment rate spiked up very quickly. It came out of nowhere. And people started to get very worried very quickly. Again, that was exacerbated by the yen intervention blow up, the yen intervention and the blow up of the yen. And so some of that has retraced. Although the unemployment rate has come down a little bit, it's only 11 basis points off of its high, unrounded. Continuing claims are at new highs. And then again, we introduce a new administration, pro-growth, potentially pro-inflation, with some of their tariff measures. That has really tried to the bond market is trying to hedge its bets here. And so it yields at 3.6%, down from 4.75 this year. Was a big move. We gave some of that back. Kind of what's the technical picture? What should we expect going from here? Now that we've gotten back to 4.5, almost 4.5, what should we expect? So this is just a chart of just the 10-year future, 10-year interest rate, excuse me. And so we're kind of hitting up against the trend line here. And in the bottom portion, we have kind of a momentum study, which is just trying to show where's the relative momentum, where are the potential turning points, is momentum improving or declining. So the takeaways from here, as we look at the 10-year yields, we're seeing a depiction of lower highs and lower lows. That is characteristic of a downtrend. So that is kind of the status quo as of now. As the momentum rolls over, it's likely that the next move in rates is at least partially to get a partial pullback in rates, meaning bonds improve a little bit. With so much uncertainty, we shouldn't expect a big move down in rates. I think a more likely outcome is kind of a chop around this 4 to 4.5%. But it's going to take a lot for us to push above 4.5%. And to get closer back up to 5, we'd need to see incredibly strong jobs reports, incredibly hot inflation reports, an incredibly aggressive tariff rollout that would happen pretty immediately. A lot of asks, so probabilistically not what we should expect from here. And so that's kind of the view of yields. Kind of move into the election. That was a big occurrence since we last talked here. So the election, what we're looking at here, this chart, we're looking at kind of voter expression. And so red is obviously Trump, Republican, blue is Harris, Democrat. And what we saw really was kind of a surprising result to some in terms of the domineering presence that Republicans had on election day. To do kind of the red wave, to get the popular vote, people were saying, how? Polling did not really express this. And really what it came down to is people and I don't want to oversimplify, but people ask themselves, what was my life like over the past 3.5 years? And what was it like under Trump? And if you said, I've been having severe hardship because of high inflation, high prices, these interest rates are hurting me, and the job market really hasn't been strong for me, you were more likely to vote for Trump. That's that top little portion there. So if you had severe hardship relative to the economic sentiment, you were more likely to vote for Trump. And so we kind of saw that through a number of the swing states there. More affluent Democrats, they're generally the kind of coastal elites. They have assets, experience very little hardship. What this does is kind of lay the narrative of a bifurcated experience here in the U.S. That people have been experiencing and are still experiencing today. It's been referred to as the K-shaped economy. And we kind of see that even on the next 2 slides here that we'll kind of touch on. So depending on where you are in the income distribution, you're either having a great time or you're having a poor time. And the economy is either great or it's terrible. And you either think we are in or are going to have a recession, or you think that's nonsense. And so this chart here it's done by the New York Fed, and it's a survey of the consumer expectations. The blue line is if your income is under 50,000, and kind of the bottom gold line is if your income is over 100,000. And what we're trying to measure in this first one is the debt delinquency expectations. Essentially, if you are making under 50,000 a year, you are very worried that you might not be able to make your debt payments here and now. Versus more affluent Americans, very little worries about debt delinquencies. We see it on the next slide here, which is kind of the asset side of it. That was the liability side. This is the asset side. What do you think stock prices are going to do? Again, if you have assets, if you are affluent, you think stock prices are going to go higher. We see that spread down, kind of gapping lower between the under 50,000 earners because they're the ones that are really hurting. So if you own assets, you're feeling like this is great. There is no recession. but majority of Americans do not. And they're feeling a whole different reality. And it's a big explanatory variable into what happened during the election. The next slide here is kind of, well, we've got the clarity on who's going to be elected. What should we expect? The two lines we're looking at here is when when job growth bottomed in COVID, we're looking at who got the jobs. Was it foreign born or native born? The blue line is actually your foreign born population here in the US. They were not born in the US, but do hold jobs here. Your kind of orange line there is the native born population who do hold jobs here. What we see is almost we've expressed this in percentage growth here. So from that low, the amount of jobs going to foreign born population is up almost 42%, only 17.5% for the native born population. So most of the job creation in this country over the past 3 years has really gone to a foreign born population here. Again, that underscores some of the frustration that I think voters were feeling. That's incredibly important for some of the policies that we're going to get in the next administration, the Trump administration. That's on the next slide here. One of the big policies revolves around immigration. So we have 3 different scenarios here that Bloomberg has identified, and kind of what is going to be the impact on population growth and prices. And the scenarios are everything from seal the border all the way to the other end of the spectrum, which is we're going to seal the border and we're going to deport all unauthorized immigrants. And so if we just seal the border, the impact to population is almost 3 million, negative 3 million between now and 2028, based on the projections. We'd expect GDP to go down about 1% over this time frame, and inflation prices to go down about 20 basis points over this time frame. On the more draconian side of the spectrum, if we were to deport all unauthorized immigrants and seal the border, about 21 million people would be removed from the population in this country. That would be about a negative 8% impact to GDP. And inflation, the prices would come down about 1.6% over this time frame. While it is important to, again, we've been underscoring this, the strength of the economy over the past about 2 years has really been the money bazooka coming out of the government, supporting industries by spending like we were in war times when we were not, and importing a lot of labor, a lot of cheap labor. And so we're really going to start to rewind that. That does have a negative economic impact at the headline level. One of the optimistic points could be that we reduce the population by so much that the impact to GDP actually on a per capita basis increases. So you could see, although you could see a hit to GDP because we're removing so many people from the country, that living standards actually improve because that income gets spread amongst a smaller base of people here. Something we want to watch. The last one coming out of this administration is tariffs. That's on the next slide. Tariffs can be a negotiation tool, more narrative versus kind of more bark versus bite, but we should expect some sort of impact. Tariffs aren't a terrible idea when you have asymmetric trade relationships like we do with particularly China, and they can be a great negotiation tactic. The Fed did a survey at the end of 2018 through the first Trump administration, and essentially said, if we get inflation, we anticipate it to kind of be ephemeral. We will mostly look through it, meaning we won't hike rates just because tariffs go on, but it could actually lead to a bump in inflation. So that's something we want to be cautioning ourselves over the next 18 to 24 months. We don't know what the degree of tariffs will be unrolled, and we don't know how fast they will be unrolled. But essentially, if we get a 10% across the board tariff implementation, it could be enough to lift inflation by about 1%. Through year end next year. So that would leave us somewhere just below 2.5% inflation. So that's something we want to keep an eye on. That could reduce some of the speed at which rates do come down from the Fed. There's a lot more. There's not a lot of granularity we have now, but we've covered a lot through the election there. Kind of the last one on the election slide is the impact of those tariffs on industries. This chart. We're just looking at the impact on the excess returns at kind of at a sector level. And kind of on both ends of the spectrum, utilities and consumer staples, real estate, they tend to do a little better during periods where you see a tariff implementation. Things like Chinese baskets of stocks, semiconductors, those get hit pretty hard there. That would be problematic for the market, considering that's one of the strong legs of the market. But kind of going through all those election slides, that's kind of what we know now. We'll keep everyone abreast of kind of the information as it comes in, and the impact that it could have on our economy and markets.
Yeah, Trey, talk a little bit now about the economy. Well, actually, I'll talk about this slide, the freight index, and the freight index basically measures transportation activity. And if the economy is really growing and doing well, you would see this line moving upwards. Conversely, it's actually going down. So shipments are decreasing. So Christmas may not be really good for a lot of retailers this year. This next slide's related. You look at United States heavy truck sales, the white line here. It's going down as well. And the red line's kind of looking at that, kind of smoothing out the trend. It's rolling over as well. So it's another negative sign for the economy. The next area we look at economically, so you look at total multifamily units under construction in single family houses, similar to what we showed earlier in the housing slides. Both these sectors are rolling over and have been going down now for over 2 years. Again, it reflects the U.S. consumer that's tapped out. They don't have a lot of money. Another area of the economy you're seeing some negativity show up is U.S. bankruptcy filings. At this time last year, or all of last year, we had 635 numbers of people that had filed for bankruptcy. We're at 570 now, and we're ahead of the pace last year. And as people lose their jobs, inflation takes a bigger hit of their paycheck. They can't afford to go on. So Trey, I'll talk about this slide too. This just basically shows some areas of debt that people are really struggling. So when you look at the orange line here, this is delinquencies for auto loans. The white line represents delinquencies for credit cards. The red line represents mortgages. And people are going to pay their mortgages first, and they're going to hold off on credit cards and cars. The purple line represents student loans, and those have been held in abeyance because of extensions by the prior administration. As those become required to be paid, you're going to see the purple line go up. So this is just more data that shows the U.S. consumer and the economy is not doing well. Trey, I'll let you talk about jobs because I think this is really important.
Yep. So our most recent jobs report that we got last month, with the caveat that it was impacted by the Boeing strike and, of course, the hurricanes that ripped through the south east of the U.S. We only created 12,000 jobs last month. 12,000. The prior month initially reported was over 250,000. And so actually the economists had already modeled in those strikes and the impact of hurricanes, and they were looking for somewhere around 110,000 jobs. So to come in at 12,000 jobs was over 2.5 standard deviations away from that median economist estimate. So job growth has really halted here. I don't necessarily expect kind of an encore next month, quite that low. But job growth has really slowed, and one of the strengths has been government jobs. As the incoming administration comes into office, they've been very vocal about firing some of those federal employees. So the leg is going to kind of get swept away from the job market here pretty quickly.
Yeah.
The next slide is on temporary jobs. That's the blue line we're looking at here. So temporary jobs, generally you cut temps before you cut your kind of payroll staff. And so it can be kind of viewed as a leading indicator for jobs. What we see here is they continued move lower in temporary jobs on payrolls. I overlaid the white line, which is the S&P 500, because these things generally move in a correlated fashion. This time, again, has been very different in terms of experience, where the stock market has continued to go higher as some of these temp jobs go lower and lower. We think that alligator mouth will shut eventually, generally with markets going lower. And the next slide we look at is kind of a full-time job picture. Most of the jobs we've created over the past couple of years, again, have been foreign-born and part-time jobs. We're not really creating many full-time jobs, and that's incredibly important for economic stability. That's the chart you're looking at here on the top, the kind of the white line. We've smoothed that out with just kind of a red moving average, just to kind of mute some of the noise in the data. But what we see is we've stalled at making full-time jobs over a year ago, and we're moving lower now. That generally happens around a recession. That bottom panel is just the rate of change, so it's kind of a 1-year rate of change, and it's negative, just under negative 1%. We generally don't experience negative growth in full-time jobs unless we are headed or in a recession. That's not a great sign. Next sign here is. Next chart here, excuse me. We've got 2 lines here. The first one is the blue line here, which comes from the Conference Board, and it's just a spread between when they do a survey, they say, hey, are jobs easy to get or are they hard to get for you? And the spread differential between the two kind of acts as a leading indicator for the unemployment rate, which is the yellow line. We've seen that spread move higher, and so we'd expect in a correlated fashion, the unemployment rate to continue to increase. Some models have that at around 4.4 to 4.5% by as early as January of next year. We'd expect the unemployment rate to continue to move higher because all the corroborating data says it should move higher.
Yeah.
Next
And what's
chart on
interesting,
top.
yeah, what's interesting is this next chart from JP Morgan, the JOLTS job reports talks about job openings, and this is very similar to the data that we've seen on the prior slides. The number of job openings has decreased. The upper right-hand chart here shows the number of people who are quitting, and people will quit if they feel like they could get a job much more easy. That's much more difficult, and you're starting to see the layoff area on the bottom right chart increase. And then if you look at the markets, we look at margin debt, and these are people who will buy stocks on margin, and we have the RSI factor. And what happens here is as the markets have the margin debt has gone up, it gets red because the market's overheated and people are more willing to take on margin debt. But as the markets go down, as you see here, it gets greener. People aren't going to use margin debt as much. So you're seeing a very hot market that's starting to unwind. And Trey, I'll let you talk about this beautiful purple and white chart. I think this is a very powerful chart.
Yeah, so this one here, the kind of the pink purple line there is exposure on a net basis for all of your long only managers out there. So you actually can kind of peer behind the curtain and see exposure and positioning of all of the institutions out there. And so right now we're at and again, though the white line is the S&P 500, we're at an extended level for that exposure. Areas in which we have been at this level or higher include, like at the end of 2017, 2018 was a very tough year for markets, included a above 10% and a 20% decline all in the same year. We see this type of positioning also heading into COVID. As investors got repositioned there very heavily. Obviously, that was a 33% drawdown in markets. And then again, finally, even at a lower exposure, but similar neighborhood here, was 2021 as people were chasing stocks post-COVID. And that led ultimately to a 25% decline. So investors are incredibly positioned, incredibly concentrated in terms of their positioning in markets now. When you get too far to one side of the boat, you risk capsizing. That's kind of where we are right now. So a word of caution. Next chart is this comes from Goldman Sachs. They've got a bull bear market indicator. Looks at things like the Shiller PE, which we looked at earlier, yield curves, unemployment, balance sheets, inflation, ISM, etc. It's looking at percentile rankings and trying to model them. So on the left there, you see the chart. We're at an aggregated 71 percentile, meaning 71% of the time back to 1955. We've never been this high. Generally, you can see this is kind of the high watermark where things start to roll over here. And you generally get not just a domestic bear market, but a world bear market. So at 71%, we're very stretched here. A word of caution there. Next chart is we look at the correlations between volatility and the market. People kind of look at the VIX index as kind of a fear index. It only rises when stocks are falling, but it doesn't have to be that way. The VIX actually starts to rise and give a vol premium when people are chasing markets and marking up implied volatility. So we have two panels. The first panel here is that correlation between markets and volatility. And the bottom panel is the subsequent drawdowns that happen. All we need to focus on are really those big green, on the top panel, those big green spikes there. So that's the tech bubble, that's the great financial crisis, that's the oil blow up in 15 and 16, and that's the 2018 chase up that led to a pretty nasty year that year. We're right back there. Anytime, and on the subsequent panel there below, we see that those levels generally gave us at least a 10% pullback in markets. Often, sometimes they went to 20% or more, obviously, in the case of the tech bubble and the great financial crisis. It took a lot of wrong to get us that low. It's not a forecast. It's just where we are. That's how far people are chasing up this market. It's going to be a bad hangover on the other side of that. And so this is another caution sign that we're getting overextended. The chase is on, but it can't go on forever. Next one here is revisions. If companies feel good about their earnings, they'll mark them up as long as with revenues. This chart here is looking at revenues in the red line and earnings, the blue line. That's kind of a histogram there. We see negative revisions all the way since back to 2022, and we haven't seen much improvement. So this is an index trying to show, are companies marking up their earnings revisions, their forecasts for earnings because they feel optimistic, or are they marking them down because they feel pessimistic? And the chart shows us that the earnings revisions are lower. Generally, only see that as we head into some sort of severe pullback, potentially recession. Not a good sign there. Next chart comes from the Conference Board, a survey going back to 1987. This line here is asking them, hey, what do you expect stocks are going to do? Do you expect them to increase? And over 51% of respondents said, yes, I expect stocks to increase. That was the highest. That was the highest reading on record. Again, back to 1987. Most people expect stocks to go up. Again, everybody on one side of the boat. Generally, not a good sign of things. The only time that we really even got close to this again was late 2017, before we headed into 2018. We saw a couple quick, fast bear markets there. So a sign of the investor sentiment there. This chart here we're looking at is just, again, something we've shown in prior webinars, something we want to emphasize: market concentration. The weight of the top 10 companies account for about 21% of all global market cap. 10 companies out of literally tens of thousands of stocks are worth 20%. So 1/5 of the index of the entire global stock market capitalization is characterized by 10 companies. That's insane. We really haven't seen that since early 70s. Didn't spell well for the remainder of that decade. Again, that's the dark blue line there. The lighter blue line is just the weight of the top 5 companies. 5 companies out of tens of thousands account for 15% of the global market cap. Very concentrated market. Last thing we're going to look at here in terms of markets, kind of just really a 101 here. And so we have a chart. We have a chart here that's showing different areas of the business cycle, whether it be recession or recovery or expansion or slowdown. And on the right there, we've tried to kind of blow up that sine wave, and we've highlighted some of the red from where we think we are here. And so we're coming out of a late cycle expansion. We are in the midst of a slowdown, and we are sliding towards a recession. Generally, at the sector level, that's what all those colored bars are. In a slowdown and in a recession, consumer staples, utilities start to outperform. Most of them are flat in a recession, or at least nominally down. The things that really get hurt are kind of your financials and industrial sectors, materials, technology. Those are the areas that should start to feel some pain as the economy does contract. We pulled some of the verbiage straight from the CFA to try and depict kind of where we are right now. And so I'm just going to read from that just really quickly here as we kind of wrap up. As the economy transitions from late expansion to a slowdown, signs of overheating give way to vulnerabilities. In late expansion, which is what we just came out of, Economic activity seems robust. It's marked by low unemployment and strong profits and rising inflation. However, capacity pressures and rising wages signal that growth is reaching its peak. Um, excuse me. Central banks respond by tightening policy, raising interest rates to prevent that overheating. This environment drives credit markets to become more restrictive, while stock markets exhibit volatility as investors weigh the risks. In a slowdown, which is kind of where we are now, the Federal Reserve or the central bank may even aim for a soft landing. Sound familiar? During the slowdown, the economic growth begins to decelerate, business confidence wanes, and investment opportunities shrink. Inflation does persist, but rising costs start to dampen demand. Capital markets start to reflect this. Bond yields flatten or decline. They reach an eventual peak, signaling economic weakness. The yield curve may even invert during this time. We're in this slowdown now. This all sounds incredibly familiar. And that signals recession risks. That's where we're going. That is what is ahead of us in the windshield here. Stock markets in recession often exhibit weakness. They favor quality stocks, defensive sectors such as utilities and staples. Credit spreads widen, particularly for weaker credits, and risk aversion rises ahead of the expected contraction. So that's kind of from a CFA 101 what you'd expect coming out of a late cycle expansion, being in the midst of a slowdown like we are now, and heading towards a recession. So really, this is kind of going according to script. And these things just take some time. We've made sure we fortified our portfolios. We're in a good spot for that. Nobody on this call needs to be worried about that. We've made some gains along the way. Still some opportunities. There's a small little Santa rally we may be able to expect through year end here as we see some kind of chasing of markets. But kind of going through the first month of next year after the recollateralization of all of the gains this year exhausted themselves, particularly the second or third week of January. We're going to see a pocket of weakness there, and we may see some gains getting taken off the table. And that's kind of the first time we want to really make sure our belts are kind of buckled in really tight. Until then, we can kind of keep humming along here as the next administration takes hold.
Yeah, thank you, Trey. I think that to add what Trey's saying on this slide, think of this as a roller coaster. We're kind of in this red area going down, and we're going to be going through a recession, and then a trough, then a recovery. But as all roller coasters, the roller coaster ends, and you get off the ride. And we've been defensively postured for quite a few months, and that's going to benefit everyone on the call. This slide here, many of you own some or multiple portfolios in this area. We're still generating the income that we told you we would be able to generate. We're exceeding all the targets with the exception of stock income. And the reason why stock income hasn't generated its 8% the last couple of 3 months, it's actually been holding treasury bills. We also have the longer duration bond ETF EDV in it for risk reduction. But they're doing what we say they'll do. What we plan on doing is, as the bond market comes to us, as we expect interest rates will come down, when that happens, we have a recession, we'll rotate out of more safe investments and start nibbling at more risky ones that have been beaten up. There'll be a better value. So with that, I'll go ahead and end the recording, and we'll open this up for phone calls.